Economics. This is Nate. Let's get started. Okay, so I have seen this pattern emerging multiple times, and a lot of people making conjectures. It's usually in periods where people think that a market is about to crash or in a bear market. Um, but the fundamentals don't necessarily paint that picture, and most people are citing things like low volume or fear as the reason why it will continue to fail, and it's usually following a liquidation event. And so what I want to talk about is how this pattern is working out. So here we see a form of accumulation that is occurring following a distribution event that ends in a liquidation period with a long wick candle, a sideways chop, ascending, descending, or sideways, with a up thrust that occurs somewhere in the middle after a few tests of the resistance. It goes up, it catches people off guard, they think that it's recovering, it doesn't recover, it goes back down into the channel and then comes out of the channel later. Once it breaks above that channel, it continues an ascent. What is this pattern? It's effectively a Wyckoff accumulation pattern. Here it is on a line chart, and you'll see you'll get the liquidation event followed by two tests of both the upper and lower ends of the channel. That'll establish the channel. Then you'll get an up thrust above the channel, a failure below back into the channel. You'll sustain, possibly breach the channel here and there with wicks, and then you'll start seeing volume come in, and that will establish the bull market back to original highs above the liquidation event. Now, this is a rather complex way of just talking about Wyckoff accumulation. This has been a rather popular topic recently because Bitcoin went through a distribution and accumulation phase of Wyckoff that needed a lot of attention and analysis to get people to understand where they were at and where we were going. And so because of those events, it's really opened the door for people to look at Wyckoff. Now, I will probably do a base video on just what is Wyckoff, who was Richard Wyckoff, and a bit of a history on his trading analysis. But right now, I'm just going to talk about this pattern that tends to throw people off. And that what I think is, and this isn't necessarily revolutionary or new, this is just me identifying a trend that this can be a way to get shaken out. Wyckoff's theoretical composite man is essentially sitting here saying, hey, I'm going to shake out all the weak hands I can, allow all the people who have conviction to gather up more, and then we'll move on. And we'll do that at a low volume point when people think that it's all over. So the accumulation phase, type 1 or type 2, really can work both ways in this trend. But the thing that's throwing people off from identifying this as Wyckoff accumulation, I think, is the upthrust in phase B. It is this pattern above the channel that doesn't really match to the standard format. And this is a variable format. This is just a trend. So the problem is in this pattern, every single version you look at, it has this thrust at the beginning of phase B that tends to make people think that that should come after the secondary test in phase A and occur before the secondary test in phase B. It doesn't occur, and then instead you have an upthrust in phase B a little later after the secondary test. This doesn't necessarily deny that this is Wyckoff accumulation because these peaks just end up at different locations. All it really does is throw you off for paying too close attention to how exact this trend is versus how the market is actually responding to the activities. So we'll go further into that. Here is Bitcoin doing it over and over again. How am I highlighting this? Well, we're in a bull market. We go through a distribution period and then we crash. This was January in 2021. We had events occur like Tesla buying and then people panic, and we went back down and tested 30,000. There was some liquidation, long liquidation candles, long wicks going on here, and then we saw the channel emerge, the upthrust, and we saw volume descend and ascend, right? What do we see again here? Here's Bitcoin again, right? And I'm using Bitcoin, but this can really apply anywhere, but it just happened so much this year that it's kind of like, all right, can we start just acknowledging that this is happening? We have a liquidation event in May, and that is the apex of the selling of after the China ban and Tesla FUD. You had the channel gone for a long time. You had 2 months of this. You had the upthrust, the failure. You had kind of a weird second move here, and then finally the takeoff. And so it isn't perfect because we can see that this band had kind of multiple views in ways you can see it, but it was a form of Wyckoff accumulation. And so it's not going to be perfect in real life, but you are going to see that the trend does generally emerge. See, we see these lines here not really get maintained, but we do see that generally this does occur. We see an increase in volume as you get into the low points of supply. And where are we at now? We're seeing the same thing. We're seeing low points in volume, beginning to rise in volume. We're not really getting the positive bullish volume that's leading to very big green candles yet. And that'll be your final confirmation here in Bitcoin for 2022. We can go back to the S&P 500 and we can see that this happens multiple times. Here it is in, what was this one? This was 2019. We saw a liquidation event, followed with some chop, the upthrust, recover. There had been a previous crash and liquidation event back in late 2018 that caused this, and the bull market was still continuing. So the bull market was intact. We had an uptrend with a liquidation event, chop, accumulate, go back. Distribution, liquidation, chop. These are very volatile. This is 2016, very volatile event. Still just ultimately bull market in continuation. Here is, oh, this one's fun. This one's 1994. You see that the S&P liquidated, went through the chop, went through it in an ascending channel, and then continued. But you see that we came back and retested anyway. So just because we have this event, this accumulative event, doesn't necessarily mean, or it's a bigger accumulation event, so a smaller accumulation event inside of a bigger accumulation event. And here's the Nasdaq again. This one was, I think this one was, oh yeah, it was the same period. So you can see that it reflected in both. I put it online because it had a lot more gaps in the Nasdaq. So you can just see that the trend generally emerges following a liquidation event during a bull market trend line, right? Now, when is it invalidated? Okay, so let's talk about invalidation. Here we have Bitcoin 2017 into 2018. Obviously, we all know now that it was in a bear market, right? But here's the thing. This is not a distribution event. This is a blow off top. A blow off top, not a distribution event, therefore won't lead into an accumulation event. Additionally, as much bullish volume as you got here, you still ended up with a small candle at the bottom side of it. That was a breakout failure, and so even though you recovered some from this wick, it doesn't matter, this pattern failed because the volume did not meet the expectations. This big candle should have led to, this big volume candle should have led to big price candles. It did not, so your failure was when you came back down here and retested and broke through, we were headed into a bear market, it was not going to be recovering. So as you saw the trend emerging on volume, you should have seen something here to show you that we were headed up. Since it did not, oh well, bye. Here is the S&P 500 in 2008, 2009. We all know that this was a, while it led from distribution into a liquidation event and cascading, we also know that the market really wasn't stable yet. So even though we got above, we see that the volume was descending. So volume was your key indicator here, was that even though we were getting price to move, it was divergent. We were not getting positive accumulation going on here. And so even though people had accumulated because they're like, hey, the S&P 500 is cheap, let me load up on it, there were not enough hands in here to really keep it going. And so it continued to fall into the actual bottom in 2009. Here's the Nasdaq following, very similar to Bitcoin, following 2000, right? So you have the blow off top, not a distribution event, followed by, again, descending volume, not really meeting expectations. So we couldn't recover back to the top here because the volume continued to descend after the accumulation event. You should have seen an ascent into volume, which you kind of did, and it could have thrown you off. But again, you still had not enough to sustain it from here. So this should have included further buy-ups. You need to see the buy-ups into phase D and E. And we did not see it continue into phase E. And then here's two on the S&P 500, 1987 Black Friday. as well as 1990 Black Monday. This was not a distribution event. And so the liquidation was its own anomalous event. So we didn't head into the same type of accumulation. This was more or less a slow V-shaped recovery or a check shape. We saw it recover, but it was after an anomalous event following a form of short-term blow off top, even though volume did not really assist in this run up. So it was weak, it collapsed, nothing to do with distribution and accumulation, a liquidation event. Here we have maybe this was a distribution event, but we didn't have strong liquidations. We had kind of like a slow cascade here by, it was fairly large percentage, like 15, 20%, but ultimately not really a liquidation event, didn't really have the same trend. So even if you were to say it, it would be better to just say, look, we're in a bull market. Here's a dip. Let me buy the dip and just move on. So not really part of the same trend here. None of these really supported the same move. And so understanding where you're at, let's say back here with Bitcoin, this still requires that we have to see volume increase at this point. Now it doesn't necessarily, because it's Bitcoin, you don't necessarily have to see volume, buying volume increase, but you can see on-chain metrics show a lot more illiquidity. But since that's not going to happen in a short period of time, you really do want to see this volume ascend. So if you don't see that volume ascend into phase D and phase E, you could say we're headed into trouble from there. And so the rules. Wyckoff Accumulation version B is what I'll title this type, but basically it's only valid in a clear bull market where institutional buyers continue to have long near-term positive outlooks. Long and near-term positive outlooks. Occurs following heavy liquidation event at the end of a distribution phase. The selling climax should appear as a very long wick red bullish hammer. Depending on the time frame you look at, that should be what you should expect. Price will form a channel below the top of the liquidation, with the support ending near the lowest price of the liquidation channel. So price should form a channel, and the lowest point of the support should be near the bottom of the liquidation candle. An upthrust in phase B will break the descending trend and then reverse back into phase C. Volume must increase into phase D, where bullish results are greater than effort, meaning you should get more bang for your buck, so to speak, in terms of the volume and the candle size. Confirmation is dependent on the sign of strength and last point of supply in phase D. So if we can't get there with the volume and we're not seeing it, then that's it. It's not going to make it all the way back up to the top. How do you trade this channel? There's a couple ways here. So first off, when you start to identify that you're headed into a liquidation event, liquidation risks become high here. When you're going down after a distribution, you see that you're still falling, you're getting up, retesting, not making it above the previous price. And so you set off a sell point here to get out of the position and wait for the liquidation to occur. You set up for the liquidation event, it crashes, it establishes the bottom. It comes back up, it retests the top of the channel, comes back down, retests the bottom, top, bottom. Once you've gotten two confirmations on both of these, you now have your channel. And so you can buy at the bottom of the channel and let it go into the upthrust. Once it goes into the upthrust, you can take the opportunity. The safest way to play this is simply if it goes back down, because you could see the volume increase positively and see the green candles start ringing here, and that this would be a much shorter W-type recovery or a V-shaped recovery, long V. If you see that event occurring, then there's no reason to hit your stop loss here. But if the channel breaks down below, or if the price breaks down below into the channel again, then you need to be getting out of your position before it totally goes back into the downtrend. And then from here, you see the pattern emerge again, where we're testing support, we're hitting low points of supply. And so you can re-enter if the volume is still indicating that we're in an uptrend or that you're getting better results for the effort that's applied. And so then you'll see the price move up, retest back down, and then as it starts to come up again, you can catch it on the rebound. So breakout, retest, resumption, take that, and then watch for these green candles. If the volume doesn't increase into phase E, then you'll know that you're going to have to exit again, because you're going to see the weakness in the price start to play out because of the lack of attention. So that is all I have. Thanks for watching. I will post this on Twitter so that people can look at the pictures exactly how it should be played. See you next time.